Hey there, welcome everyone. I'm Sunny from the Success Blueprint Frameworks for Work and Life YouTube channel. Today I'm going to dive deep into stock market for beginners. This is just educational video giving you the high level into the stock market. This is not a financial advice. We're going to unpack all the essentials, and by the end you'll have a solid understanding of the core ideas and some strategies to avoid common pitfalls. First pitfall, don't immediately jump into picking stocks. Instead, it is important to get your financial house in order first. It's all about laying the foundation, tackling high-interest debt, especially credit cards, before you even think about investing. Imagine you're paying the credit card company a much higher rate. Most credit cards charges around 22% interest rate. Stock market historical return is around 8 to 10%. You're essentially losing money and it's working against yourself. It's a no-brainer when you put it that way. So step one, conquer the debt. Next up is building that financial safety net, your emergency fund. I recommend aiming for 6 months of living expenses stashed away in a high-yield online savings account. Why online, you might ask? Well, traditional banks, with all their overhead costs, offer tiny interest rates that basically get eaten up by inflation. Online banks operate more efficiently and can pass those savings on to you in the form of higher APY. For example, Betterment Everyday Savings is currently offering a 4% APY, which is pretty competitive. With that emergency fund in place, you're less likely to panic sell during a market dip. It prevents you from having to sell at a loss, which can really shake your confidence. It's all about riding out the storm. Having that cushion allows you to stay the course, even when the market gets bumpy. So now that debt's under control and your emergency fund is ready, let's talk investing. There are several different strategies, from the more passive approach like ETFs to the hands-on, potentially riskier active trading and day trading. First, you need to figure out which one might be the best fit for you based on your personality, risk tolerance, and goals. It's like a personalized roadmap. For instance, if you're someone who prefers a hands-off approach and values long-term growth, passive investing using ETFs might be a good fit. ETFs, or exchange-traded funds, are like baskets of stocks that track a particular market index. This gives you instant diversification. You're not putting all your eggs in one basket. But I should point out that even passive investing requires discipline. You have to regularly rebalance your portfolio to maintain that asset allocation you're going for. Discipline is key. So ETFs are for the set it and forget it crowd. But what if you're looking for a more consistent income stream from your investments? Let's talk dividends. However, it is not as simple as just chasing the highest dividend yield. You really need to do your research and find companies with a solid track record of paying dividends, and more importantly, make sure those dividends are sustainable. Remember, a company can cut or eliminate its dividend at any time. They're not guaranteed. Now, for those who are more adventurous and enjoy a bit of risk, there's stock picking, trying to beat the market by choosing individual stocks. I want to acknowledge that stock picking can be very exciting and potentially lucrative, but it's also high stress. It requires a lot of research. It's not for the faint of heart. You need to really understand how to evaluate companies, analyze financial statements, and assess risk. And then there's trading, active trading, and day trading, which I really caution is incredibly risky. The vast majority of people who try it actually end up losing money. It's important to remember that trading is not investing. Investing is long-term growth. Trading is trying to time the market and capitalize on short-term price fluctuations, often driven by emotions, which can lead to impulsive decisions and costly mistakes. Greed turns winners into losers. That's a pretty powerful statement. So we've got our investing styles laid out. How do we actually get started? Well, that's where brokerages come in. First, you need to select an online broker. Selecting a broker is like a matchmaking service. For dividend investors, retirement savers, and passive investing fans, I'd point you to M1 Finance. It's a great option if you're looking for fractional shares, automated rebalancing, and these customizable portfolios they call pies. What's really impressive is they also have expert pies created by professionals with no asset management fees, unlike traditional advisors who take a percentage. That's a big deal. Let's say you're intrigued by stock picking, or maybe you want to dip your toes into active trading. I'd suggest Webull for that. Webull is perfect for the learner. They offer a free stock bonus when you fund an account and have a risk-free trading simulator. It's a great way to practice your skills before you put real money at stake, like test driving a car before you buy it. For those who prefer a truly hands-off approach, especially for retirement, I'd give a nod to Betterment. Betterment is ideal for passive investing. For a reasonable fee of 0.25%, they handle everything: investing, rebalancing, even something called tax loss harvesting, which can boost your returns. And for my international listeners tuning in from outside the US, I'd mention First Stride as an option. First Stride offers broad country support and a unique feature called stock-level dividend reinvestment. So no matter your investor profile or where you are in the world, there's a brokerage out there for you. Now let's shift gears a little bit and explore why so many people struggle with investing and how to avoid some of those common traps. There are fundamental principles that are key to success, starting with how we actually make money in the stock market. It boils down to two main things: dividends, those regular payments from companies, and asset appreciation, which basically means buy low, sell high. For example, Facebook or Meta, whose stock price grew over 156% in the past 5 years, versus Ford, which was down 46%. It highlights how not all stocks are created equal. It's crucial not to put all your eggs in one basket. I cannot stress diversification enough. Spreading your investments to manage risk, so if one investment takes a hit, the others can help cushion the blow. It's like a financial safety net for your portfolio. I recommend not putting more than 20% of your money into any single asset. But I also caution against over-diversifying to the point where you can't really keep track of things. Start with a manageable number of stocks, maybe 5 if you're a beginner. One of the most important aspects of investing is to recognize and avoid speculative bubbles, those times when everyone is piling into an asset, driving the price sky high, often detached from any fundamental value. Think dot-com bubble, housing bubble, maybe even some of the hype around certain cryptocurrencies. One piece of advice: if your friends who know nothing about investing are buying it, run. It's humorous, but it drives home the point. You've got to do your own independent research. Don't get caught up in the frenzy or swept up in the hype. It's like that old adage: if it sounds too good to be true, it probably is. Speaking of avoiding emotional traps, I really want to emphasize the importance of ignoring the noise, that constant barrage of news and opinions that can sway your decisions. It's tough to stay focused when everyone's either panicking or celebrating. But remember, the market is like a pendulum swinging between optimism and pessimism. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." It takes discipline and a clear head to make sound decisions amidst all that chaos. So when everyone else is selling, that might be the time to consider buying, and vice versa. It's not quite that simple. It requires careful analysis and understanding the fundamentals. But the point is, don't let emotions drive your investment decisions. Another misconception I want to tackle is the idea of cheap stocks. Just because a stock has a low share price doesn't mean it's a bargain. The way to understand this concept of market capitalization, which takes into account the number of shares outstanding, is as follows. A company with 100 million shares trading at $10 a share has the same market cap as a company with 1 million shares trading at $1,000 a share. So the share price alone doesn't tell the whole story. You've got to look at the bigger picture. Speaking of value, I want to highlight a long-term tax advantage. If you hold a stock for more than a year, you qualify for a lower capital gains tax rate. Patience really pays off. You benefit from that potential long-term growth and a reduced tax burden when you eventually sell. We've covered a lot of ground on the basics of investing, from understanding different strategies to avoiding common pitfalls. Now let's explore one of those powerful tools for building long-term wealth, the Roth IRA. Roth IRA is like a caveman shelter. The Roth IRA is like this haven that protects your earnings from the elements, in this case, the tax man. It offers some incredible advantages, especially when it comes to retirement planning. Unlike traditional IRAs, where you get that tax break up front, with a Roth IRA, you contribute after-tax money. So there's no immediate tax deduction, but here's where the magic happens. All your earnings grow tax-free, and when you withdraw them in retirement, you don't owe a single penny in taxes. That's a sweet deal, especially considering how taxes can really eat into your returns over time. The Roth IRA also has some advantages over the 401k. It offers a flexibility that a 401k often lacks. For example, you can withdraw your contributions anytime, no penalty, which would be a lifesaver if you run into an unexpected financial hardship. Plus, there are no required minimum distributions in retirement, which gives you more control over your money. There are income limits for Roth IRAs, so it's always a good idea to check those out and see if you qualify. You also have to have earned income to contribute. But even if you're a high earner above those limits, there's a strategy called the backdoor Roth IRA that allows you to bypass those restrictions. It's a clever workaround for those who want to take advantage of Roth IRA benefits. For maximizing retirement savings, I suggest a three-pronged approach. First, maximize your employer's 401k match if they offer one. It's essentially free money. Then max out your Roth IRA contributions. And finally, direct any excess savings into a taxable brokerage account. If you're feeling a little overwhelmed or unsure about the best path for your specific situation, it never hurts to consult with a fee-only financial advisor. Moving beyond retirement planning, I want to emphasize the importance of diversifying your assets. Not just within the stock market, but across different asset classes altogether. It's like building a balanced meal for your portfolio. You wouldn't want to eat only one type of food, so similarly, relying solely on stocks can expose you to unnecessary risk. Let's talk about some alternative investments to consider. There are A-seats like real estate, bonds, even a little bit of cryptocurrency. Bonds typically offer lower returns than stocks, but they tend to be less volatile, making them a good option for balancing out those riskier assets in your portfolio. It's all about finding that sweet spot between risk and return. As you get older, you might want to shift a larger portion of your portfolio into bonds to preserve your capital and generate a steady stream of income. Real estate seems like a popular choice, but it can be a little intimidating for new investors. The benefits of owning physical real estate, highlighting its tangible nature and the potential for rental income and appreciation. I specifically recommend owner-occupied multifamily properties where you live in one unit and rent out the others. It's a great way to generate passive income and offset your housing costs. A good example is purchasing a multifamily property that includes a main house, 2 apartments, a cottage, and even a barn. By renting out those additional units, you can essentially live for a fraction of the cost. It's a clever strategy, but I realize, being a landlord isn't for everyone. Some people might prefer a more passive approach to real estate investing. That's where crowd-funded real estate comes in. It's like fractional ownership of real estate. You pool your money with other investors to buy larger commercial properties. This model is democratizing access to private real estate, which was traditionally only available to the wealthy. Platforms like Fundrise allow you to invest in these projects with relatively low minimums, sometimes starting as low as $10. It's like Kickstarter for real estate. You can invest in projects that align with your values and risk tolerance. Now let's talk about the wildcard cryptocurrency. I acknowledge that cryptocurrency is highly speculative. It has potential for big gains, but also substantial losses. I stress that you should only invest what you're willing to lose. It's definitely not for the faint of heart. The cryptocurrency market is still relatively young and incredibly volatile. I recommend doing your research, choosing a reputable exchange like Coinbase, and prioritizing security by storing your coins offline in a hardware wallet to protect those digital assets, especially with the rise in cyber attacks. Having explored a range of investments beyond the stock market, I want to emphasize a holistic approach to building a well-rounded portfolio. Consider your risk tolerance, time horizon, and financial goals. And if you're feeling overwhelmed, it's always a good idea to consult a qualified financial advisor for personalized guidance. Investing is not one size fits all. Now let's delve into what I'm particularly excited about. Those mysterious forces that make stock prices go up, down, and, well, sometimes seemingly sideways. Let's go behind the curtain to see what's driving those price changes. The market can feel like a roller coaster sometimes, but understanding those forces at play can help us navigate the ups and downs more effectively. It's like having a backstage pass, peeking behind the curtain to see what's really driving those changes. It's not always about big economic pronouncements. Sometimes it's the small stuff that can have a huge impact. Let's start with something we already discussed: earnings reports. These quarterly checkups give investors a glimpse into a company's financial health. They're like a report card showing how much money they made, how much they've spent, and other key metrics. Wall Street analysts scrutinize these reports, and their expectations play a huge role in how the market reacts. If a company beats expectations, investors get excited, buy more shares, and the price often climbs. But here's the thing: a lot of times that good news is already priced in. Investors are pretty savvy. They anticipate positive results, and that anticipation is reflected in the stock price. So even if a company has a stellar quarter, the stock might not move much because everyone was already expecting them to do well. It's like trying to surprise someone who already knows what they're getting for their birthday. The element of surprise just isn't there. On the flip side, when a company misses those expectations, the stock usually takes a hit. But even then, I caution against jumping to conclusions because sometimes bad news is already baked into the price too. If a company's been struggling and investors are bracing for a disappointing report, the stock price may have already declined. It's all about understanding the context, not overreacting to headlines. Let's talk dividends. I stress that dividends are not guaranteed. Companies can increase, cut, or even eliminate those dividends, and these changes can really impact the stock price. A dividend increase is usually seen as a positive sign. It boosts confidence and drives up the price. It signals the company is doing well and wants to share those profits with shareholders. But I warn you, don't get seduced by high dividend yields alone. A high yield could be a sign that the company is struggling and using those dividends to try to attract investors. I stress again, you've got to dig deeper, look at the financials, and make sure those dividends are going to be sustainable over the long run. It's like checking under the hood of a car before you buy it. You don't want a shiny paint job hiding a lemon engine. Now let's shift gears and talk about something that can generate a lot of buzz product news. Those exciting product launches, dreaded recalls, and legal battles can really make or break a company's reputation. Investors are always paying attention to that stuff. I've got some great examples. Apple releasing a new iPhone typically creates a surge of excitement and drives up the price. A classic example of product innovation leading to market gains. On the other hand, a major product recall, think Chipotle a few years back with those E. coli outbreaks, can damage a company's brand and send the stock plummeting. It really highlights the importance of staying informed, paying attention to the good and bad news. Informed investors are better equipped to make sound decisions. Let's talk about layoffs, which often make headlines and can create uncertainty in the market. Layoffs are usually seen as a negative sign. But I want to make an interesting point. They're not always bad news. Sometimes they're necessary for a company to streamline operations, become more efficient, and ultimately more profitable. In those cases, it can actually be a positive thing in the eyes of investors. A company that's willing to make tough decisions and adapt to changing conditions can actually boost confidence. On the other hand, if a company is laying off a huge percentage of its workforce, that could be a sign of deeper trouble. And investors are going to react negatively. Like anything else in the market, there are nuances to consider. Speaking of market-moving events, let's talk about acquisitions. When one company buys another or when a company goes private, it can trigger a flurry of activity, sending stock prices soaring or plummeting. It's a high-stakes game. Sometimes investors get a sweet deal when a company is acquired. If the acquiring company pays a premium for those shares, shareholders can walk away with a tidy profit. But it doesn't always work out that way. Sometimes shareholders feel like they're getting the short end of the stick. If that acquisition price is lower than the current market value, they might feel undervalued. And sometimes those acquisitions are done to rescue a struggling company, which isn't a great sign for long-term investors. It's all about who's getting the better end of the deal. Let's tackle something that can be confusing for new investors: stock splits and reverse stock splits. A stock split is essentially when a company divides its existing shares into multiple shares, lowering the price per share. But the total value of the company stays the same. It's like slicing a pizza into more pieces. You still have the same amount of pizza, but now you've got smaller slices. I'll use Apple's 7-for-1 stock split back in 2014 as an example. That split made Apple shares more affordable for the average investor, and the stock price continued to climb afterwards. A reverse split is the opposite. The company combines multiple shares into a single share, increasing the price per share but reducing the number of shares outstanding. It's like taking those smaller slices of pizza and putting them back together, forming fewer but larger slices. While stock splits are often seen as a positive signal, reverse splits can sometimes raise red flags. A company might use a reverse split to artificially inflate its share price or to avoid being delisted from an exchange. It's a tactic that warrants further investigation. Now let's move on to management changes, which can have a ripple effect throughout a company. I really want to emphasize that the management team is like the captain of the ship, steering the company's course. Any changes at the top, especially the CEO, can be significant. A new CEO with a strong track record and a clear vision can really inspire confidence and send the stock price up. But a CEO who's embroiled in scandal or making questionable decisions can really erode trust. I specifically want to mention the CFO as someone to watch. The CFO plays a crucial role in managing the company's finances, so if they suddenly depart, it could be a sign of trouble, like a canary in a coal mine. We've covered a lot of specific events that can move stock prices, but sometimes the whole market takes a nosedive. These market corrections can be triggered by many things: rising interest rates, inflation fears, geopolitical turmoil, or even just a sudden shift in investor sentiment. It's like the market taking a collective deep breath after a long run-up. I want to emphasize that corrections are a normal part of the investing cycle. Not necessarily a reason to panic, they can even create opportunities for savvy investors to buy stocks at lower prices. The key is to distinguish between a market-wide decline and a company-specific problem. If the whole market is down, but one of your stocks is tanking even further, it's worth investigating. Something might be going on with that particular company. Speaking of broader economic factors, let's talk interest rates, which can have a significant impact on the market. Interest rates are like the control knobs for the economy, and the Federal Reserve. The Fed gets to turn those knobs. When rates are low, it's cheaper for businesses to borrow money, which can stimulate economic growth and make stocks more appealing. But when the Fed raises rates to combat inflation, it can make borrowing more expensive and slow down the economy. It's a delicate balancing act. The Fed is constantly monitoring the economy, trying to find that sweet spot between promoting growth and keeping inflation under control. Those decisions can have a real ripple effect throughout the market. Another economic indicator that can influence stock prices is the unemployment rate. When unemployment is low, it usually means the economy is doing well. People have jobs, they're earning money, they're more likely to spend, which is good for businesses and good for the stock market. But when unemployment is high, that can signal a struggling economy, and that can weigh on stock prices. It all comes back to understanding that broader economic context. Well, there you have it. We've explored this fascinating world of the stock market, from those fundamental principles of investing to the sometimes baffling forces that make prices move. We've learned about slaying debt, building an emergency fund, choosing an investing strategy, diversifying our assets, and making sense of those market swings that can feel so unpredictable. I have given you a really valuable toolkit to navigate those complexities and hopefully avoid some of those common pitfalls. Remember, knowledge is power. The more you understand about this market, the more confident you'll be in making informed decisions and achieving your financial goals. Stay curious, keep learning, and never be afraid to ask questions. There's always something new to discover. Thanks for joining me on this deep dive into stock market for beginners. If you found value in this video, please hit that thumbs up button. It really helps the channel grow. And if you want more frameworks for success in both work and life, don't forget to subscribe to the Success Blueprint Frameworks for Work and Life. I release new content regularly that will help you optimize various aspects of your personal and professional life. It's been a pleasure sharing this knowledge with you. I'll catch you next time for another adventure in building your success blueprint.